Well, it's never too early to start saving for retirement. With sky-high inflation, the anticipation of additional interest rate hikes, and fears of a potential US recession, investors are continuing to seek out the best practices to keep their portfolios protected. Well, now Vanguard's annual report, How America Saves, compiled the saving behaviors of nearly 5 million defined contribution plan participants across Vanguard's business last year. And despite all the uncertainty in this tough economic climate, retirement savers are staying the course. The data highlights that Americans generally remained resilient. For a deeper dive into the report, we're joined by Joel Dickson, Vanguard Global Head of Advice Methodology. Thank you for joining me this morning, Joel. So, how surprised are you at how resilient savers have been despite everything going on with the macro environment?
Well, thank you, Rachelle, for having me today. I don't know that it's actually that surprising. This is the continuation of a trend, this concept of resilience that we've seen in the retirement plan market over the last 10 to 15 years. But that in many ways had been during more advantageous market environments. The last year, as you mentioned, much more challenging, high inflation, market volatility and uncertainty. Yet that concept of resilience really does still come out and if anything, even improved during 2022. You see that in savings rates. For example, more than 25% of plan participants were contributing more than 10% of their income to their long-term retirement savings. And we saw a record high average deferral rate of nearly 7.5% last year.
So then what have been the most effective ways that you've seen people growing their savings over the past year?
Really, the main effective change over the last 10 years or so has been the real growth of automatic investment programs and approaches in the workplace retirement plan area. The auto enrollment, auto escalation of savings, and the use of single investment solutions to do that automatic investing, so-called target date funds are a common example of this, have really allowed very broad access to low-cost, well-diversified, suitable asset allocation portfolios for plan participants. And the fact now that roughly 3/4 of plans that have more than 1,000 participants in them offer these automatic savings features is really a testament to that growth. And you see it in different ways that show good behavior on the part of participants. Increased savings rates, increased plan participation rates, and also lower transactions being done by participants in response to market volatility or market events.
So for people who are wondering if they would do better going with a professionally managed account versus AI or trying to do it themselves, what sort of returns are people seeing when you stack them up together?
Well, it's interesting. We are seeing a definite sort of, if you will, the next growth area in the retirement plan space in many ways in terms of plan designs and plan options is this concept of low-cost personalized advice to really allow those that may not have the time, the willingness, or the ability to manage their long-term portfolios to meet their goals, to do this in a more automated way. And in fact, we are seeing that growth in retirement plan offerings from an advice standpoint, where now a much larger percentage of plan participants have access to low-cost advice. About 2/3 or so are turning to professionals for meeting their long-term needs in terms of their savings and investing strategies. And being able to do this directly through a retirement plan option is in many ways that next way of really boosting potentially investors' long-term outcomes within the retirement plan design and landscape.
And it does make more sense as we do seem to be getting into a phase of a lot more nuance in this economy than we were sort of obviously pre-COVID. I do want to ask you, though, for your top tips to establish and stick with your saving goals, especially when you look at the high amount of debt people have. You're sort of trying to figure out, should I be saving? Should I be paying off the debt? What are your top tips for really growing your savings?
So First of all, I think that the most important thing is we all love to talk about and follow kind of the markets and the economy and so forth. And as you said, Rachelle, there's a lot of nuance, if you will, in that these days. But over time, your long-term success as an investor to meet your, for example, retirement goals are really in many ways totally under your own control through your own actions. By saving enough, by minimizing your costs, both taxes and investment costs and transaction costs along the way, by making sure you have a low cost, diversified, suitable investment mix for your long-term goals, and then sticking to that plan over time. Those things will allow that long-term success in many different market environments and economic situations. I guess I would say that, in the case of people that are trying to manage debt versus investing and saving in a retirement plan, a couple of real high-level tips. First of all, take full advantage of any employer match that you may be able to, and then think about paying off your really high interest rate debt and not reestablishing that. And by the way, I think it's important. Paying off debt is a form of saving. So, all of this opens up your future long-term savings capacity. And then you probably do need to think about also, how do you weather potential future economic conditions or storms that may occur on the horizon through things like having a rainy day fund at your disposal should the need arise.
I do appreciate those tips. I know a lot of people could always use them. A big thank you there to Joel Dickson, Vanguard Global Head of Advice Methodology. Thank you for your time this morning.
Thank you very much.